Today, we're going to talk about the small business retirement plans for 2023. And we're not just going to talk about all the different plans, but how do you use them together? So I'm going to talk about the traditional IRAs, the Roth IRAs, SEPs, Simples, and solo 401ks. That's basically what we're going to be talking about today. And if you also have a workplace plan like a 401k or a 403b, they're going to be on this guide that I'm going to go through. So you can also see how you can use those together. And I'll talk a little about that as well. So let me go ahead and pull this up on the screen. Let's jump right into this. So this is going to be the PDF guide that we're going to go through. And you can get it on our Discord server, and I'll show you what that looks like if you're not familiar as we go through the video. But I'm going to go through the traditional IRA and the Roth IRA first, so you can see how those work, the SEPs, the Simples, and you can see here on the chart, we also have money purchase plans and profit sharing. I'm going to talk about the profit sharing sides of the retirement plans, not just standalone plans. And then we're going to talk about, you can see the 403b right there, Roth 403b, and also the 401k, the Safe Harbor 401k. I'll explain quickly what those are. And then, of course, the solo 401k, also known here is written as the individual K, and the Roth side, the Roth individual K. But I usually just refer to it as the solo 401k. So let's go ahead and start with this right at the very top and looking at the traditional and the Roth IRAs. Now, with the traditional and the Roth IRAs, this should be used in conjunction with your small business retirement plans. So that should be how you think of things. And you're going to see that it's more difficult to use these two types of accounts when you have certain plans like the SEP IRA. So let's start with the traditional and the Roth IRAs. If you're not familiar with them, you can save up to $6,500 in 2023. And it says it right here. And I'll use our arrow to show you. For 2023, that's going up to $6,500 for the traditional Roth IRA. Spousal, that simply means if your spouse does not have earned income themselves, but you do, then you can consider that earned income when you're making a contribution for your spouse. And then the guardian is if you have a dependent or minor children and you have any of these types of IRAs, traditional or Roth, in their name, they're just saying that it's considered a guardian account. That's similar to a UTMA account. If you have a child or a minor, they'll have basically their investment account. It'll be a UTMA account. It's the same type of account as a regular investment account. So that's what the guardian means there. So $6,500 in 2023. And if you haven't filed your taxes yet, you can still put in $6,000 for 2022 up until your tax filing deadline. So it's going up by $500. Now, the catch-up contribution is for if you're 50 or older. So in the year that you're going to turn 50, you can actually put in the additional $1,000. You don't have to actually be 50 years old, but in the year that you're turning 50, that tax year, you can put an additional $1,000. That means you can put a total of $7,500 for 2023. So that's what that's showing right there. So when you're looking at these two types of accounts, the traditional and the Roth, they aggregate. So that means you can split it up any way that you want, but you can't go over the total limit of $6,500. So you could not put $6,500 into the traditional IRA and $6,500 into the Roth. However you break it up, it has to equal a maximum of $6,500 if you're under the age of 50. Now, if you are doing a backdoor Roth, that is a non-deductible contribution, and then you're going to convert over. Anything that you convert doesn't count. That's just a conversion. It's basically like a rollover. You're rolling it over from one account to the next. That is not a contribution. That is a rollover, or in this case, a conversion. So that does not count towards that limit. It's a question I get asked every now and again. So it's just the new money. Think of it just the new money going into any retirement plan. That is going to be the contribution. You can do as much conversions as you want. If you want to do the full amount, if you want to do more than just the $6,500, you can convert as much as you want, which will not affect the amount of your contribution. So it's just contributions. Now, these two plans, when you're thinking about these, should stand alone from your other retirement plans if you're really trying to save as much as you can. And when when you're putting the money into these types of plans, you just have to know, can you put it into the traditional IRA? Can you put it into the Roth IRA? And we have that down here. So if we first look at your modified adjusted gross income to figure this out for your Roth IRAs, can you make that Roth contribution? If you're a single filer, that phase out begins at $138,000 for modified adjusted gross income. Most of the time, or a lot of the times, your modified adjusted gross income is simply your adjusted gross income. The modified portion is if you have to add certain things back. From 138 to 153,000 is the phase out. So if you have a modified adjusted gross income that's below 138,000, you can put the full $6,500 directly into your Roth IRA. For married filing jointly, then it is 218,000 to 228. It's based on your filing status. So if your modified adjusted gross income is 218 and you're married filing jointly, then you can make that full contribution. It is not based on your income, it's your filing status's income. So it's really important that you understand that. So if you are earning less than 218,000, but your spouse is earning what would put you over that limit, then in fact you are over that limit. So that's how that works. Now, if we go down here, I think there's another part here that'll show us the IRAs. So here we go. So the IRA limits to make these contributions if you have a workplace plan. So if you have a workplace plan, these numbers will apply. Otherwise, you can make a contribution to your traditional IRA at any income limit. But if you have a workplace plan, then there are limits. So if your modified adjusted gross income is $73,000 or less, you can see that right here, $73,000 or less, then you can make the full deduction. Now, what does that mean? A full deduction is what I was just talking about, making that backdoor Roth. That is a non-deductible contribution. In this case, it would be a deductible contribution. So that would reduce your taxable income. That is the way to think of it. So let's say you're earning $100,000 and you put in $1,000 into your traditional IRA as a deductible contribution. That means your taxable income then is $99,000. So it will fall by the amount that you make the contribution. If it were a non-deductible contribution, let's say you put that $1,000 into your traditional IRA as a non-deductible contribution and your adjusted gross income was $100,000, it would still be $100,000. So that's how that works. Now, as far as the self-employment tax goes, this question kind of confuses a lot of people. What about the self-employment tax? That gets taxed no matter what. So if you have your small business and you're paying that self-employment tax, whether or not you put it pre-tax into any of these accounts, any of them, whether it's the traditional IRA or your solo 401k or your SEP or your Roth side, it does not matter. You're still going to have your self-employment tax. This is only for your federal income taxes. That was the only thing that's going to be affected here. So you will still have your self-employment tax. So here we go with modified adjusted gross income. So that goes up to $116,000. It says $116,000 or less is fully deductible. And then there's a phase out from $116,000 to $136,000. And I didn't say that up here, but for singles, there's a phase out from $73,000 to $83,000. And then over that, you will have to do a non-deductible contribution. And usually when you're doing these non-deductible contributions, you're going to end up doing the backdoor Roth. The reason being is it's not wrong to do a non-deductible contribution and leave it in your traditional IRA. But if you don't have to deal with that and you can just roll it over to the Roth, you're going to likely be better off because any of the growth then will, if it's in the Roth IRA, will then come out tax-free. But if it stays in that traditional side, that growth part to the non-deductible contribution will then come out as ordinary income. So it's really in your best interest to get it over to the Roth, but it's not wrong. There are scenarios where I prefer to keep it in the traditional side as a non-deductible contribution, but that's just something to consider. And you're going to see that as we go through these plans, as we tie them all together. So let's go back up to the top and we'll start with the SEP. Now, I like the SEP sometimes. And with the Secure Act 2.0, We're going to have the Roth side to it. And in fact, let me see when that date goes into effect. I have the Secure Act cheat sheet here. I haven't memorized that yet. December 31st, 2022. So we're already in that. So 2023, you can have a Roth side to your SEP IRA and make those contributions. But just because it has a Roth side to the SEP doesn't mean I would lean towards the SEP IRA just because, oh, well, now I have my traditional side and my Roth side, and it's a pretty simple plan to open up versus other types of plans. I'll use this one. Well, I wouldn't do that. The reason being is because when you're putting the money into the traditional IRA, let's say as a non-deductible contribution, and you want to do that backdoor Roth conversion, you're going to get stuck in the pro rata rule. And the pro rata rule says that, I'm going to actually draw it out here for you. It says that if we have our traditional IRA here, TIRA, and we make a non-deductible contribution, then, and we want to do this conversion over here to the Roth side. So that's what I was just talking about, right? So you know what? Let's just put it as a non-deductible contribution because I earned too much. We'll put it into the traditional IRA and then we'll immediately convert it over. Non-deductible contribution into your traditional IRA. There is no such thing. A lot of people get confused by this. There is no such thing as a non-deductible IRA. It is a non-deductible contribution going into your traditional IRA. Now, I don't care if you have 17 traditional IRAs. It doesn't matter. They all get roped into the pro rata calculation. So you can't say, oh, well, I only had non-deductible contributions to this traditional IRA. That doesn't matter. It ropes in all your IRAs, including the SEP IRA. So if you're making contributions to the SEP, then guess what? All that pre-tax traditional money is going to get roped into this pro rata rule. And it's not the fact that you are going to pay taxes on your conversion, but when you're making that $6,500 or whatever contribution into non-deductible contribution into your traditional IRA, and you can only do a portion to it, well, that full amount, let's say we put in $6,500 and let's say that we wanted to convert the $6,500, but we had some money that was pre-tax into either of these two accounts, then only a portion of this is actually going to get converted. So you're still stuck with that non-deductible contribution. And then you have to rely on your 8606, or you're going to look at your 8606, which is your tax form to help you track which is non-deductible versus pre-tax. And in doing so, you're basically going to be stuck into this pro rata rule for all eternity until you fix it. You know, it's not like it's broken, but until you basically get all that pre-tax money out of here. So until you do that, you're going to be stuck with the pro rata rule when you're doing those conversions. So that is why I wouldn't necessarily jump to the SEP IRA saying, oh, now they have the SEP IRA on the Roth side, so best of both worlds, great, we're done, and that's it, right? No. What I would lean towards if I had the opportunity is the solo 401k, and we're going to get to that. So let me go ahead and scroll down here, and we're going to go take a look at that really quickly. So we're going to skip the simple for just a second. So we're going to look at the solo 401k or the individual K. That is not included in the pro rata rule. That alone makes it, in my opinion, a much better plan than the SEP. But if we're looking at these two plans, the solo 401k, you can only use it if you don't have any full-time eligible employees. Where the SEP, you can't have employees, but a negative of that is going to be the fact that you're going to have to put in whatever percentage you contribute into your employees as well. So let me see if it actually outlines it right here. So it's saying 25% up to 25% of compensation up to $66,000. $66,000 is going to be for 2023. And really quickly, these plans, you're going to see these numbers over and over again, right here. So we can see it right here, 100% of compensation or up to $66,000 for 2023. If you're still in 2022, 100% of compensation up to $61,000. So that is the maximum that you can put in, and that's up to 25%, approximately 20% for sole proprietors. It works out. It is 25% for sole proprietors, but there's this funky math because of net profit, what it's based on, but then it's Deductible is 1/2 of your self-employment. It's a formula thing, but it's still 25%. So don't think that you're giving your employees 25% when you're only really allowed 20%. It's still 25%, just the way the math works out. So it's 25% of your compensation. If you're an S Corp, really simple, it's 25% of your W-2. That's it. So if you pay yourself of a W-2 in your S Corporation, then you can make a contribution to your SIP. Otherwise, you can't. But if you are a sole proprietor, Schedule C filer, then it is going to be a little bit of a math equation to get to it. But you're going to basically do 20% of your plan compensation. It is not your net profit, it's your plan compensation. So that's the same amount for all employees that are eligible for the plan. So you can't pay yourself, you can't contribute more to your plan and decide that you're not going to give it to your employees. It has to be the same across the board. So when does it make sense to use a SEP in that kind of an instance? If you have close family members that you actually want to make a huge contribution to their plan just as much as you would your own plan. And that's really the idea. You're not going to open up these plans and just contribute like 1 or 2%. You really want to pack these things. Most people, I find, go right to the max. What's the most I can put into this plan? Let's open it up and let's fund it. And if you do have those employees that you do want to actually make those types of contributions, just be aware that it's required. So that is a part or feature or benefit of the SEP IRA. And you could see the eligibility right here. It's age 21 or older, worked 3 of the last 5 years and earned at least $650 in each of those years, and may exclude union employees and non-resident aliens. So if they don't meet those requirements, then they're technically not eligible. And if those are the only employees that you have and they're not eligible, then by all means, the SEP IRA might be a good plan for you to use, where you can put in that amount. But again, I could still find ways to get more money into the solo 401k, and we'll get to that in a second. So I still like the solo 401k in almost every aspect better than the SEP, but the fact that if you do have eligible employees for the retirement plan, then it eliminates that solo 401k. So maybe you're only left with the SEP IRA. Vesting is 100%, meaning that your employees could take the money from the retirement plan and move it to their own plan if they are no longer employed there. There's no vesting schedule. You see vesting schedules in workplace plans, but not for these types of small business plans. They don't have them for the SEP IRA. So that's how you can kind of use them together. And you can use the SEP with your traditional and your Roth IRAs. So if we go back up to these plan limits, and I think a lot of this stuff just gets confusing for people. Like what is the most that you can actually put into these plans? You can put in $66,000 plus $6,500 into your traditional and your Roth. So do your traditional and Roth, split up however you can or want, $6,500, and then do an additional $66,000 into that plan. They're also called 415 limits, but that's how you do it right there. If you Google this, you'll see some IRS, some guidelines on those numbers for the 415 limits, but that's what it's referring to. This is the most that you can put in. So if we scroll down a little bit, we can move on to the next plan and we can look at the simple IRA. Now, if I have employees and I wanted to contribute to their plans, I might actually lean towards the simple IRA. So if I had eligible employees, this is probably going to be a little bit easier plan to deal with than the SEP, just because you could, in some instances, get more money into your own plan. And if they don't really want to contribute, then you don't really have to worry about it. So if you look down here, the contribution limits and requirements are right here. So the employees can defer up to $15,500 for 2023. 19,050 or older. So that's including the catch-up contribution. So let's scroll up really quickly again on this cheat sheet. And again, I'm going to let you download this on our Discord server. So you can see the simple plans right here, $15,500 plus the catch-up limit of $3,500. That's if you're 50 or older. And that is the most. Now, by the way, if you're making a lot of money, so if you're over these limits right here, this 415 limit of 265, this is the most plan compensation that you can include in your calculation. Now, if you do the math, in some of these plans, you're going to hit these limits just by doing the math. but 265 is the most that you can do. The simple IRA could be one of those plans that if you're earning this amount, I think the math would work out that you might not max it out at either 2 or 3%, depending on how you're doing it. What am I talking about? Let's go back to that. So let's take a look at the simple here. You have a choice when you're setting up this plan. And that choice is right here. So the employer must match dollar for dollar up to 3% of compensation or 2% of compensation as a non-elective contribution. A non-elective contribution means that you can do a lesser amount, which is just 2%, but you're going to give every eligible employee 2% of their compensation, even if they don't contribute to their own plan. So if they don't make a contribution, then you would still have to give them 2%. You could think of that part as the match, but they don't have to actually contribute anything to get that match. That is what a non-elective contribution is. Or you can do the 3%. I think the 3% is a better deal and it makes more sense to me. Why have a retirement plan? It's an incentive to get your employees to save for their own retirement and give them a little bit of a boost of a benefit for your compensation package. That's basically what it is. But if they're not contributing, let's say they're just not interested in it, they don't really value it, you're still forced to do the 2% if that's what you chose as a non-elective. So 3% elective, meaning they have to put 3%, and then you will match them with 3%, or on the other side, you're going to give them 2% no matter what. Again, I like that 3% match because it says, hey, if they take their retirement seriously, then so will I. And that's basically the way I look at it. So that is your choice when you're dealing with the simple IRA. And you can see right here, it says that you can lower it to 1% for 2 years of every 5 years. I don't know if I've ever actually seen that. I'm sure there are plans out there that do that, but I guess if you fall on hard times, you can do that. Your employees won't much appreciate that, but you have that flexibility there. But again, I haven't seen that on a plan, I don't think ever. And I don't know if I've ever even heard of anyone actually do it. But I'm sure somebody will leave a comment at some point that their simple IRA was reduced. So let's see what else we got here. So the vesting is still 100%. So if you make that 2% and they quit the next day, it's their 2%. It's basically the way that you would look at it. With all the retirement plans on the distributions, it's after age 59 and a half. That's pretty much a given on the retirement plans that we're dealing with. And there are no loan features to this plan either. And there are no loan features on any of the plans for the small businesses that we're going to really focus on this channel. And you can see them right here, the workplace type of plans that you're going to see over here. And there are small businesses that will have these type of plans, a profit sharing or money purchase plans, but they're going to be much fewer and farther between. And then you can see here, probably the 401k has it too, and the Safe Harbor 401k is going to have that loan feature. Oh, and that's right. You can have a loan feature on your solo 401k, but you're going to need custom plan documents on that. So if you're watching one of my solo 401k videos, I do touch on that briefly, that to have custom plan documents to do all of the features that the solo 401k can actually do. So that is what you would want to look out for. I'm going to go ahead and skip over these two plans right here. You can see kind of the benefits, and I'm going to talk broadly about workplace plans in conjunction with your small business plans. And I'm going to show you how to get a little bit more into these plans than you might have originally thought, or why you should have a small business plan, even if you have a workplace plan. So here, the 401k, the Roth 401k, that's your regular, what you would think is your regular 401k. And then over here, we have our safe harbor provisions. The only real difference in these plans is that they don't have the same testing if you have this amount, but then there's going to be a contribution amount that you're going to have to meet in order to have these plans. But that's basically the difference between a regular 401k and a safe harbor 401k, is you're going to be able to avoid some of the testing if you have some of these plans. And it's also 100% for both. Vesting is 100% for both employees and employer contributions. That's part of the safe harbor because there could be a vesting schedule. Let's see, vesting 100% for employee contributions, vesting schedule allowed for employer contributions. So that's what you're going to have there. That is basically wherever there's a gimme, there's a gotcha on the safe harbor provision that you're going to have to make this contribution and it's theirs day one rather than saying that there's a vesting schedule to it. Then with the solo 401k, the solo 401k again is by far, in my opinion, one of the best plans you can get, but you're likely going to want the custom plan documents. And the reason is that there's prototype plans and then there's going to be the custom plan documents in a nutshell. The prototype plans don't allow you to do things like the mega backdoor Roth strategy. So if you're familiar with a backdoor Roth, you can do the same concept or the same strategy in your solo 401k. But in order to do it, your plan has to allow for it. And a lot of the broker dealers, I don't think any of them, I think all of them go with the prototype plans. Reason being is because they are not responsible for the reporting requirements when you're doing those transactions. So if you do your own custom plan documents, that kind of falls on your shoulders. But in my opinion, as long as you know what to do, it's pretty simple and it's well worth it. So you can get a lot more money into your retirement plan and do that backdoor strategy to get more into the Roth side. So let's talk a little about how you can get more into the solo 401k versus the SEP. And then you're going to see why that combination makes a lot more sense. So I'm going to just bring this right back up here. So we have our SEP over here, but the reason I would go with the solo is because if we're making, say, $100,000, then quite simply, if we're an S corporation, it's going to be 25% of this amount, $100,000 as a W-2 employee of your own company. You can only put in $25,000 into the SEP. If it's a Schedule C filer, you're going to do a little bit of math, but it's going to work out to 20% into the SEP. That's it. There is no employee side. That is what you're missing. On the solo 401k, you can do the exact same math on the employer side. So it's 25% if you're an S corporation or 20% if you're Schedule C, plus the employee side. So you get the employer and the employee side at a much lower dollar amount as far as compensation goes. So let's say you have an S corporation where you're breaking up your W-2 versus your distributions. Those distributions, while they're not subject to self-employment tax, they're also not eligible because they're not considered earned income. They're not considered eligible for your retirement plans. So you can keep this number much lower and get more money into your solo than you can into your SEP. That is one of the biggest reasons why I like this plan. And the second one is that you can still take advantage of clearing out your traditional IRAs and getting it into your solo. Now you might be thinking, well, couldn't I do that with my workplace plan? You could, but I don't recommend it. And the reason I don't is because the workplace 401k has a limited amount of options into what you can invest into. And I like to have more control over my retirement assets. So I would prefer them to be in a plan like my solo 401k, which you can invest in basically any security that you could in your traditional or your Roth IRAs. So you have a lot more flexibility. And that is the reason why I would go with the solo 401k. Now, that is also another reason why if you don't have a retirement plan and you don't have a small business and you're still watching this video, get a side hustle to open up one of these plans, make a little bit of money, then open one of these plans, clear out your traditional IRA, and then you're cleared to do the backdoor strategy without the pro rata rule. Makes it a lot simpler. So even if you don't have one of these plans currently, find a way to get that opened. Now, as a last note before we end this video, now make sure that when you're doing this stuff that you're aware of the common ownership rules, because if you try to open up a side business over here, but you have this business over here and you're like, well, I want to do this solo 401k, so I'm going to open up a business where I'm the business owner and I have no employees. But if you have another business and you're, say, like 100% owner of it, then you're going to be required to make contributions to their retirement plan. So that's going to land you some hot water when you realize I've opened up my solo 401k for this other business. But if you own multiple businesses, you're going to have a problem. So just be aware of that you need to make sure that you understand how this works. Workplace plans, if you're an employee, that's no big deal. You can have your side hustle, make those contributions, and you're in the clear. So that was a brief overview, so to speak, of how these small business retirement plans work together. Hopefully this chart will help you out. Join the Discord server. We literally just started it. If you have questions, put them in the Discord server. Hopefully we'll get to them and maybe we'll do some more videos based on those questions. And thanks for watching. Be sure to subscribe and we'll see you on the next one.